What's the difference between funeral insurance and a funeral trust? Have you ever wondered how to best prepare for funeral expenses? Understanding the difference between funeral insurance and a funeral trust can help you make informed choices. Let's break it down. Funeral insurance, also known as burial insurance or final expense insurance, is a specific type of life insurance. This policy is designed to cover funeral and burial costs. The insured pays premiums, often without needing a medical exam. When the insured passes away, the policy pays a lump sum to a named beneficiary, usually a family member. This beneficiary then uses the funds to pay for the funeral expenses. One key point is that the policyholder does not contract directly with a funeral home. The payout from the insurance is generally unrestricted, meaning beneficiaries can use the money as they see fit. Funeral insurance functions similarly to traditional life insurance, but usually has smaller coverage amounts and is easier to obtain. Importantly, because the payout is a death benefit, the funds are not considered assets during the insured's lifetime. This means they do not affect Medicaid eligibility directly. On the other hand, a funeral trust, also referred to as a burial trust or irrevocable funeral trust, is a legal arrangement. In this case, funds are deposited into a trust account, often held by a funeral home or a federally insured bank, specifically to pay for funeral services. A funeral trust can be revocable, allowing changes or cancellation, or irrevocable, which means it cannot be changed or canceled without consent and court approval. Irrevocable funeral trusts are particularly relevant in Medicaid planning. The funds placed in these trusts are no longer considered the individual's assets. This helps preserve Medicaid eligibility while ensuring that funeral expenses are covered. The money in the trust is usually restricted to use by the designated funeral home. If the funeral home offers a guaranteed price contract, they assume the investment risk of the trust funds. The trust funds may be pooled with others in a master trust or held individually. The value can fluctuate with investment performance unless guaranteed by the funeral home. Since the trust is specifically for funeral expenses, it provides peace of mind that the funds will be used as intended without burdening heirs. Now let's look at the key differences. Funeral insurance is a contract with an insurance company where beneficiaries control the payout. In contrast, funeral trusts involve placing funds in a trust, often controlled by the funeral home or trustee, limiting how the money is used. Regarding flexibility, funeral insurance policies can be canceled or changed, while irrevocable funeral trusts cannot be revoked or altered without legal approval. When it comes to Medicaid and asset protection, irrevocable funeral trusts help protect assets from Medicaid spend-down requirements. Funeral insurance proceeds are not counted as assets during life but become part of the estate after death. Lastly, the use of funds differs. Funeral trusts restrict funds to funeral services at a specific provider, while funeral insurance payouts can be used by beneficiaries for any purpose, although they are intended for funeral costs. Estate planning. Establishing an irrevocable funeral trust can allow individuals to set aside funds for funeral expenses without jeopardizing Medicaid benefits. Funeral trusts ensure that funds are dedicated to funeral costs, preventing heirs from using the money for other purposes. Funeral insurance offers a simpler option for those wanting to provide financial support for funeral expenses without tying funds to a specific funeral home or trust arrangement. Understanding these differences can help you choose the right option for your needs and ensure that your funeral expenses are covered without affecting your eligibility for assistance programs.